Good morning, I'm John Delano. This morning on the Sunday Business Page, the stock market takes a dive this week. What's really happening in the roller coaster market? We'll be devoting our entire broadcast to the market, mergers that are affecting it, and your own investments. It's all next right here on the Sunday Business Page.
The Sunday Business Page on KDKA TV is brought to you by Stewart Capital Advisors. Experience the power of the Piper.
Good morning and welcome to the Sunday Business Page. Just last week we were telling you the good news about the Dow Jones Industrials reaching the so-called magic 14,000 mark. But the magic didn't last very long. As CBS Alexis Christoforous reports, the market lost more than 300 points last Thursday, the second big loss in a week, and left investors wondering what it all meant.
The selling started right out of the gate this morning. Just a week after blasting through the 14,000 milestone, renewed concerns about higher oil prices, a credit crisis, and the housing slump drove the Dow down 450 points before a slight rebound.
The fear that the residential real estate market in this country is worse than we thought it was.
New home sales tumbled far more than expected in June, down 6.6%, the biggest drop in 4 months. So it's no surprise that home builders are reporting big quarterly losses. The other big issue for investors, concerns about a credit crunch. A slew of corporate mergers and buyouts helped drive the markets higher in recent months. But after Daimler Chrysler had difficulty financing the sale of its Chrysler unit to Cerberus, investors are worried.
What that does is beg the question, what other deals will not get done in this marketplace?
Analysts say there is a lot of volatility in the market, and we may not have hit bottom just yet. So there could be more trouble down the road on Wall Street. At the New York Stock Exchange, I'm Alexis Christoforous, CBS News.
The Sunday Business Page on KDKA TV is brought to you by Stewart Capital Advisors. Experience the power of the Piper.
Well, we're back to where we started at the beginning of this broadcast. And with a volatile market, what can you do to protect your investments and even look for growth? There's one school of thought which says, don't get caught up in the headlines. Match your investment strategy with your own time horizon. DiNuzzo is president and founder of DiNuzzo Investment Advisors from Beaver, Pennsylvania. Last month's issue of Financial Advisor magazine chose his firm as one of the top 250 financial advisors in the country. That puts his company among the top 1.5% of all similar firms. PJ joins us this morning for the first time on the Sunday Business Page. Welcome, PJ. It's great to have you here.
Good morning, John.
Tell us a little bit about your company. You're located in Beaver, Pennsylvania?
Yeah, Beaver, Pennsylvania, out in the West Hills of Pittsburgh. We were founded in 1989, and we manage approximately $250 million, around close to $250 million, based on financial planning. We're members of NAPFA, the National Association for Personal Financial Advisors, which is the fee-only organization, and we're managing money for our clients and providing financial planning services.
And you told me before you got started here that you've got a satellite office.
Satellite office, yeah.
In downtown Pittsburgh.
Downtown Pittsburgh. Yeah, we have for our Pittsburgh clients who meet downtown during the day, they can break away for an hour or so. But we have an office here in the investment building as well downtown.
I love that. Tell me about the kind of clients you represent.
The type of clients we represent are just really, truly a slice of Pittsburgh. Folks have worked their whole entire life, have accumulated a nest egg, primarily in their 401k or 403b at work with accumulation, and have been saving money on the outside. Maybe there's some stock options or different things, and now at the point of inflection when they retire, now they're not adding to their portfolio anymore. Now they're getting to the distribution phase, where this portfolio has to last them for the rest of their life.
Well, with the volatile market that we had last week, what kind of advice are you giving your clients nowadays?
Ours is, we view this as just noise at our firm, and our motto is really the asset allocation we talk about constantly. And really we spend a lot of time on the front end matching up our clients, their unique situation, and customize a portfolio for them along with their time horizon you mentioned earlier.
So you don't care about the fact that the market dropped this last week?
Doesn't matter at all to us.
Doesn't matter at all?
Doesn't matter at all to us.
And I assume that means you don't think it matters to the individual out there watching the show.
Well, it matters, but really what matters at the end of the day is making as much money as possible with as little risk as possible. And the institutions, we deal directly with them. If I called them up and asked them what they're doing in their plans, they would say, PJ, you know, we're not making any decisions. We're still holding large cap, small cap, international, real estate. We're still holding all of our major asset classes.
So what is it that you're saying to your investor out there? Hold even, don't do much of anything, or look at where you are now and change it around?
Yeah, if you go into the right areas, if you're in the proper areas of the stock market, internationally, domestically, and some complementary areas, and you're diversified properly, really, the average institution has about a 65-35 split, about 2/3 stock and stock-type investments and 1/3 bond and bond-type investments. And really, a lot of people who are oversensitive to the market fluctuations have 100% in stocks generally, so they are a lot more skittish, which they should be. They're not really. They really don't have a good asset allocation.
So your advice is to check over your own portfolio and make sure that you have. Is that the breakdown you believe? 2/3 in stocks and equities and 1/3 in bonds.
Yeah, for the average client, that's a real good mix now. As clients get further into retirement, and if they really it's driven off of your personal cash flow statement, you may be able to have a portfolio of 50% in stocks and 50 in bonds, and even sleep even better.
Right.
Yeah.
PJ, how do you choose among all the 401ks out there, all the different investment models that you can go with? Most of us have a 401k through our employer, and we get all these choices. And as you know, when you call those folks, they tell you, we can't advise you.
Yeah.
It's really kind of crazy, but that's what they tell you. And so what is your advice?
Our advice is we recommend, we believe that the market is highly efficient. Efficient market theory is what we believe in, and we recommend our clients to index as much of your portfolio as possible.
What does that mean, index?
Index is what you would see in a lot of plans. You'd have the opportunity, maybe a Vanguard S&P 500 index, or maybe a Vanguard small cap index, even Fidelity and some of the other firms will have them available. And the average index is going to outperform 2 out of 3 approximately active managers over a 5 to 10 year period of time.
Mm-hmm. Mm-hmm. Now, is there a particular index fund that you like right at the moment?
Well, we're one of the first 100 firms in the United States that was approved and have been on board with Dimensional Fund Advisors, DFA, which is an institutional family which provides exposure to all the areas that I was mentioning earlier. So we love DFA. We think they're the best at what they do for efficient market theory.
We only have about a half a minute here. What is the biggest mistake that you find local investors make?
Biggest mistake, really, if you look at the research from Dalbar, Sorelli, Mercer, is it's amazing that the average individual investor does only 1/2 of what the market does over time, or only 1/3 of what it does, and it really all relates down to emotions. The average individual investor just becomes too emotional. Set a good asset allocation, diversify as well as possible, index as much, and you'll be happy at the end of the day.
And that's what we all want, to be happy at the end of the day. PJ DiNuzzo, thank you. We're going to have you back. We appreciate you being with us.
Thank you, John.
We'll be back with a program note and more of the Sunday Business Page in just a few moments. Stick with us.